Thank you for joining us. I'm Gord Long. As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed and prolific writer on the web, who is the publisher of the website of2minds.com. Welcome back, Charles.
Thank you, Gordon. It's always my pleasure.
Charles, before we begin, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends we are identifying and simply make our discussions available to everyone for those that might be interested or want to contribute constructive comments, which we welcome. We have a significant number of slides to share, and therefore we'll move along quickly. So let's just jump right in on today's discussion concerning the potential impact of the coronavirus on the global economy and financial markets. Everyone is asking how bad will this get in regards to the financial markets and whether most of the damage is now already done. We'll give our views on this, and as such we'll be discussing these areas shown here on this chart. Before we begin, Charles, any comments?
No, we're just going to cover the results of what we were discussing for the last 4 months, which is the fragility and vulnerabilities in the financial and economic systems, and now all that's coming to pass.
Warren, this chart here shows us, and I thought it was a good way of starting, Charles. Warren Buffett said it all. It is only when the tide goes out do you discover who's swimming naked. You know, and in my view, this is exactly what is happening. There's been these huge number of rocks hidden below the surface, which you and I have been discussing in these videos, that have now become quite apparent and obvious to everybody, as they always do during times of crisis. The acknowledged catalyst for this crisis is the coronavirus or COVID-19. And its unexpected demand and supply shock. Both shocks together are unprecedented and certainly not ever seen on a global basis. I think since World War II would be the closest we could come to where both of this happened on a global basis. The critical crack, though, that initially is being exposed is what we warned about in our last session, and that is collateral inadequacy, or more accurately, inadequacy, stemming from extreme debt and its distorted supporting leverage levels. And the critical tipping point here, and this to me is very important, Charles, in my estimation, on a longer term basis, our impact will be a shift to fiscal policy or helicopter money from and because of monetary ineffectiveness. And this shift is really the major outcome from all of this. And we haven't seen it yet, but I'm seeing it being talked about and has to be talked about in the EU government and in the Federal Reserve, or rather in Congress, not the Federal Reserve, but in Congress. Comments on those points, Charles?
Yeah, I think we're going to cover those in greater depth, and I totally agree. And we've often talked about the social impact of the systemic fragility, and so that monetary ineffectiveness is the social mood has changed, where people are not going to tolerate the Federal Reserve bailing out Wall Street again, while leaving everyone else who's just lost their jobs twisting in the wind. So it ties into things we've been talking about for years.
Yeah, we may have quantitative easing and people aren't going to accept it, but we better have quantitative easing for the people. But that won't come out of the Fed. It'll come out of the government. It's going to be a fiscal stimulus that has to come, or it's going to be demanded. Even if it doesn't come, it's the only way we're going to fight this off. But we'll kind of get into that a little bit later here. In many ways, Charles, in my opinion, we have almost a perfect storm that hit. As I mentioned, a global shock in both demand and supply, an unexpected oil war initiated by the Saudis here a couple of weeks ago, which is creating a shock to the whole high-yield credit market infrastructure. We got monetary stimulus showing itself, as we just said, ineffective and frankly just insufficient. And volatility now that's higher than in the fall of 2018 when we had the whole fix-a-mageddon, they called it, crisis and the Nuchin massacre at Christmas, which again is removing the perception of a Fed put. And that's a whole disruption in itself. And the markets no longer are following. They've broken from the global liquidity proxy, which we've been showing at and tracking here for a couple of years at MAD-SII, and how closely the markets follow. It's completely broken from that and isn't even attempting to try and come back towards it. What is presently occurring, and you put out an excellent article here today, Charles, on markets repricing themselves. But what we're doing is we're repricing of risk. That is, in the credit markets, we're seeing it. We're pricing in a recession. We've already brought that forward. Maybe it's not fully in, but we have, and that's showing itself in PE multiples. We're repricing earnings, and that hadn't really totally begun to happen, but earnings per share, earnings are going down, and per share, because the other point people haven't come to grips with, the whole market has been driven by corporate buybacks and dividends, and that's going to shift. The cash flows are not going to be there, and the lending is not going to hurt us, is not going to come. I'm not saying it's going to stop, but it's going to slow dramatically. And you've got, like, for example, the airlines that spend 80 to 90% of all its cash flow buying back its shares. Now we're asking for a bailout. This is politically not going to be allowed to happen. I mean, what were they thinking of? Comments on this chart, on these set of charts, Charles?
Yeah, I really like how you've summarized the perfect storm and what's occurring. And we've often spoken about a reset, and repricing is part of the reset. Like assets that were overvalued or based on massive leverage, they're going to be repriced, and the system's going to reset more to reality, and that process is probably going to drag out for quite a while. And that's partly what we're going to talk about going forward here in our discussion. So to me, this is the chickens coming home to roost. When you create an entire economic system that's based on speculation and debt and leverage rather than on increasing productivity, you've created a systemic fragility so that these shocks, if our economy and financial system were healthier, we might be able to better navigate these. But we've created an extremely fragile, brittle system, and that's why the reset and the repricing is going to stretch out for probably the rest of this year, if not beyond.
Charles, we took $4.5 trillion of cash flow and money and borrowing to be spent on buybacks and to some degree dividends, but buybacks that just disappeared. That's money that wasn't invested, as you just, into productivity, and it's gone. It just disappeared in the stock market. So look at what we would have done with a $4.5 trillion investment in infrastructure, as an example. This whole fantasy that you and I have been talking about for the last 5 years is blatant right there in front of us, and that's what's happening. And in our 3-part fall series that we had, we showed this diagram that I've got up here now in almost every session, and we were indicating we expected, we called it a stability test to soon arise. Maybe not quite as soon as this, but we knew it had to come. In my opinion, it has, and the global financial system is now going to be thoroughly tested. And as you just said, it's not going to be short term. It's going to take a while for confidence to come back. And we spelled out that the investment challenges for the 20s in an era of global conflict in our thesis paper here at MAD-SII will be and we put it in our wrap 2 in our series together, to anticipate and handle radical policy extremes, and that's what's going on. Changing rules, that is laws, regulation, and taxation. That's already happening. I just read that tax deferral we pushed out tax filings for 90 days, et cetera. We're changing the regulations and laws, already happening in real time. Preparing for disruptions and shortages. Look around the grocery stores, at least in my area, shelves are 50% empty. And maintaining real capital. We said this is going to be the new challenge. It's right here in front of us. And it all sounds a little eerie as we're beginning to see it all happening now. I don't know what you're seeing, Charles.
Right, exactly. Well, I really appreciate that you've posted a chart of the S&P 500 just to show the incredible drop here. and the dynamics in play, the collateral shortage, the demand for dollars, and then your slide on the flow of money. You know how liquidity's now been disrupted, and things are no longer working that in the way that we anticipated pre-crisis. And
Exactly.
so I'd love to hear your explanation of that.
Yeah, let me just start on the S&P chart there too. First, the markets have plunged, in my estimation, or ours at Matt SAI, to critical levels we've never experienced. We never experienced at the depth of the 2018 financial crisis. Over here on the left is the bottom at the 2018 crisis, and you can see with these bands, which are 2, 3, and 4 standard deviations, we never got down to the lows of those standard deviations on a 200-day moving average, even in 2018. But you can see ever since in any kind of sell-offs, we either touched it or hit this solid black line. But now we've already busted through slightly the 4 standard deviations on that 200-day moving average, because we've had a value at risk, or VAR shock, to the regulated financial industry, which has triggered, as we said, is collateral shortages, which is presently forcing a horrendous scramble for US dollars, or more precisely, euro dollars. And these levels could get worse. It's still simply unknowable. Even if we see violent counter rallies, and we will, which may or may not be quickly faded, they normally are in an unfolding bear market, we still won't know for a little bit of time whether we're going to break further down, even with some violent counter rallies. But we're at a really important test right now. Between now and 2 or 3 days after quadruple witch, this Friday being a quadruple witch and yesterday being a very important Bradley turn date. This is, and we're only talking things that are short term. I didn't say these are longer term. They're counter rally kind of elements. So that's where the market is right now. We'll talk a little more about that later. But this chart, the financial system's plumbing can get plugged in many different places. And that's what the Federal Reserve and everybody with the facilities are trying to unplug, because it's plugging up in very many different places. Because there's a difference, and people, I don't think, fully grasp this. There's a difference between liquidity, flows, and credit. Central banks can create liquidity, as they have been, but the money center banks may not turn it into flows, and nor may the smaller banks that get it from them and financial lenders turn it into lending, nor will consumers in some cases want to borrow. So there's different elements all the way through there, which determines how much you're going to pay for it, what the spreads are, whether there's collateral adequacies at the banks that are, before anything can flow. And the jury is still out on whether they're actually getting this whole thing unplugged, or can get it unplugged before some pipe permanently breaks. Any other comments on that chart, Charles?
Yeah, I think it's a great chart to discuss finance, but also the real world economy, because you have a lot of notes here about household bankruptcies, postponed investment, layoffs, and we're getting reports from the ground in China that everybody's opening their stores again, and people are allowed out wearing a mask, but there's a social and economic impact on the loss of confidence. People are not willing to spend in the same way they were pre-crisis, because they're not sure their income is stable, right? Because of these global demand and supply shocks. Like, for instance, just to state the obvious, China's factories can reopen, but guess what? If there's no demand for the products because the rest of the world's in a deep recession, then that doesn't solve China's problem. There's going to be a huge amount of layoffs and reduced wages there. So there's this uncertainty and loss of confidence is it's a hidden part of the financial plumbing that you described.
It's critically important. I got a slide a little later. We'll come back to it. This loss of confidence is going to lead to stagflation. It typically does, and it's a next milestone. And it's probably going to be one of the most permanent disruptions that comes out of this. One stung, right? and people react and become much more cautious. It's just human nature. It can be expected. The degree to which it happens is important. But this next chart, Charles, we need to keep in perspective what this plumbing is trying to handle. We're talking about historic debt and leverage levels, a fragile and unbalanced global economy, and a likely end to the debt super cycle, things we've been talking about for a long time. We have financial assets that, and we're talking about backdrop to this, for this plumbing, was 5.6 times a plunging GDP, which is highly likely to go negative over the next couple of quarters minimally, and with it negative cash flows to pay the already onerous debt burdens in place, which will become more expensive to even roll over. These are the things that could bust some of these pipes, and will, or I expect to. We have a financial system now resting on leveraged debt that increasingly has insufficient secured collateral to sustain itself from either massive levels of this debt rollover I mentioned, or new debt required to support highly leveraged CLOs and zombie corporations. Remember, Charles, this Bank of International Settlement said 15 to 20% of all corporations in the world now, major corporations, are zombies because their cash flows don't even pay their debt payments. They have to borrow to do it. Hello. And then we have this something called rehypothecation we talked about in previous shows, which has reached its end game. Banks' last fall's repo reaction crisis we saw in the fourth quarter last year clearly illustrate it can no longer trust other global banks, and most importantly, the shadow banks' collateral. And personally, Charles, and I may be overstepping, I smell something big at Deutsche Bank, which has 80 billion in notional derivative structures, and I think that all the other banks are extremely nervous, and that's what's getting into the LIBOR right now. But that's for another day. We now live in a new world of structured finance that involves collateral transformations to effectively bandage or rig the system. We talked about this in our series, and as this chart shows, nothing has changed since 2008 crisis. It's only the names and the increased magnitude of problems that has actually changed. And borrowing short and lending long only works with plenty of two fundamental bonding agents: liquidity and trust. That is your confidence there, Charles. Both have become potential problems in differing regards, and tenuous problems which the whole global financial system really depends on. And the worse these problems get, the more creative the financial system has forced to be, such as the advent of even these collateral swaps. I mean, it's craziness. Comments on any of that?
Yeah, I think this chart shows that this coronavirus crisis is actually simply part of this much longer cycle where the debt super cycle is going to roll over, and there's going to be consequences throughout the global economy. And I think we can start with the net worth of households. In other words, as this is eventually going to impact real estate. The stock portfolios have already taken a hit. A lot of assets are going to be repriced much lower as debt is taken care of either by default or selling other assets to pay down debt. And so it's gonna really impact households' sense of well-being and wealth as the so-called wealth effect of rising assets pumped up by this debt supercycle. As those reprice to more rational levels, there's going to be a reverse wealth effect. People are going to feel poorer, and I think a lot of people are probably opening their 401k statements and already feeling poorer. So this impacts not just high-level finance; it impacts households too.
In a massive way, to the point that, as you know, the U.S. government's talking about sending every U.S. citizen and child money here within I think they're talking April 3rd. But anyway, frankly, Charles, the distortions have become too big to handle, and this is what this chart we showed in prior sessions was to indicate. We now have an unregulated, over-the-counter $500 trillion swaps market in currency and in interest swaps, at least according to the Bank of International Settlements. The two pillars the global financial market rests on, which are interest rates and currencies, are based on the U.S. dollars for currencies and the U.S. Treasury's risk-free bond for interest rates. This temporarily is supporting the global economy, which is only 80 trillion. Not 550 trillion. Something has to give. Either the swaps market collapses under its own weight, shown in this chart from the right, or from something small destabilizing it from the left, which could be the coronavirus, and just there's a stall in the economy that's enough to tip this whole thing over. We showed this one, the Exeter collateral pyramid, has long stood the test of time during periods of turmoil, instability. But according to this model, those derivatives with the weakest and furthest links from base money are the first to be rejected and potentially bankrupted. And as confidence vanishes and a broad-based liquidation process ensues, the higher risk asset class values cascade and collapse towards their underlying real collateral value. It should be, as this chart says, gold becomes real money again. But Charles, I warned in at least at MATA in January to stay away from gold and silver, even though I'm a big hawk on them and have been since the spring of last year. But I felt that silver would fall as it has. And I'm showing what we'd set up here in the top left, and where we're at right now here as of yesterday. We also said gold would fall, but not quite as hard, which it has. And you can see we're getting pretty close to our targets that we specified or thought back there. But both have fallen in paper value as leveraged positions have been sold to support more dramatic collapses in other assets and to get their hands on euro dollars. So gold is suffering from that. But the drop is not nearly as bad as you might think, since gold denominated in U.S. dollars has been impacted by exploding higher U.S. dollars. In actual fact, it should be a little bit worse than we thought, but it seems to be right on track. I still believe sometime in between now and the spring, and with a little bit of stability sets in, that hard assets are where people, or value is going to, because of this confidence and fear, are really going to start to move towards. And especially when I think that there's and I've espoused this before, we're going to see a potential inflation shock hit coming from the global supply chain that's always been exporting deflation to the developed world, may be starting to export inflation in a big way to stay alive. Comments?
Yeah, I love your chart here of the loss of confidence, because that's really what we're talking about. Is there's the we can count the financial impact in terms of dollars or GDP ratios, but the human psychology is going to be a big driver here. And once there's a crisis of trust, as we've discussed, and you have here on your chart, then that's part of what's going to drive the repricing or the flow of cash to precious metals, because people will lose confidence in all other assets. And I think I suggested we look at a chart of comparing crashes, and you can see that in past more or less financial driven crashes, the crash played out over many months and even years. And this crash is completely different. I mean, it's just a straight line down. And so it shows the vulnerability and the fragility of the system, that the crash has happened so quickly. And I have a chart that I drew up on February 2 showing the exponential growth of the coronavirus spread. And what I wanted to mention here was I think we can fairly safely predict that there'll be a leveling off of the cases, and there'll be a sense that it's all under control, and so authorities will lessen the quarantines, and life will sort of resume. But that doesn't mean the coronavirus is done, right? That there's probably, if history has anything to tell us, there'll be a wave 2. And so then there'll be a renewed sense of fear and renewed financial disruptions. And I think I can't. Of course, we don't know when that will happen, but that's what history suggests.
Charles, both those charts are really, really great charts. We could spend a lot of time further time on both of them, but I'm going to back up just to a second. I have a chart I'm putting up on the fiat currency cycle, and because I've always been expounding, those charts are about the catalyst that's going to drive some of the emotions and the changes, but the bigger picture to me is where it's the whole unsound money basis and a fiat currency underpinning that's in trouble now, in major trouble. And this chart shows the cycle that we should expect to go through and have been progressing. And we were at the bottom of this chart in terms of gluttony, and that is basically driven through a monetary policy where government just creates new money and credit at will, and that's what we were doing with quantitative easing, et cetera. But the point I made earlier, and is coming through now, is I believe we're now going to move to the abuse stage, this transition where it's going to be not just monetary, it's going to be obscene, if I can use that word, fiscal policies. $2 trillion on infrastructure. It's going to be all of these free helicopter money to every American and child. This is the beginnings, because now it's just going to be almost irresponsible under the excuse we have to stimulate the economy. We have to avoid the Great Depression that's going to be here, or the recession, and monetary policy won't work. And that's what we're into here. But the point I also want to make, and goes back to the point you've been making in this session, is about confidence. You see the next chart above abuse? It's lost confidence, and that goes back to the chart that you mentioned about, that I'm showing here, of lost confidence, because when it goes, it's the foundation of investment. When confidence goes, you lose, certainty and optimism disappears, and you get this uncertainty, which leads to plummeting growth and jobs and investment and stagflation. And that's what we're on the road to. And unfortunately, and I've done some work to our subscribers, Matt SII, and stagflation is going to be one and the same with nationalization. I know Americans hate that word, whether we're going to call it conservatorships. We'll come out with all sorts of words. But to guarantee the system and make it work, the government's going to start having to seize control. They won't use those words, but guarantee, they're nicer words. We're going to see nationalization in a much bigger way starting to seep into the system, because it's the only way that the governments are going to perceive that they can fix these problems. But it's not going to work, and you can see on the fiat currency chart that we showed, the step after that becomes the failure. We're well on a road to this. Any kind of closing comments here, Charles, before we kind of say what we think's in front of us?
Yeah, no, I'd like to hear that you describe the two events that you anticipate are necessary to stop the financial market carnage.
Yeah, we talked about this before the show. We can see counter rallies and, a lot of news flashes and rumors and everything else. But two things have got to happen. And without both of them, if one of them happens, we might be able to get some level of stability, but it's going to take both of these to happen for the market to start moving back up in any kind of sustained fashion. I don't necessarily say that one of them I support. I'm just saying that this is what's going to have to happen. The one I do support is that until the virus, the coronavirus rather, curves start to flatten out. Just right now, they're going up exponentially. I didn't say reverse and come down, but just begin on a second derivative, start to level off slightly. Until that happens, we still don't know. But when the moment that starts to happen on a global basis, never mind on the U.S., and you can track these, they're both available. I have the two charts on my desk every single day. Until they start to level off, the markets can't price properly. They don't have any clear way to really speculate on how long, how sustained, the impact on bringing forward a recession. But that allows some better pricing. That might allow some stability. Isn't going to change the market. It'll just kind of stabilize things in my estimation. What is going to be required, and I hate to say it because I don't believe in this, but it's going to take massive fiscal spending in the tune of $2 to $4 trillion out of both the U.S. Federal Reserve, U.S. Congress, and out of the EU in spending. And how they choose to do it, hopefully it's in highly productive areas, infrastructure that's required desperately in the United States, but whatever, until they pump that kind of money into the system. And there's big price to be paid future with this, Charles. It doesn't come free, but without it, we have the unmistakable situation where we could collapse into the Greater Depression. That's how serious it is, not because of the coronavirus, but because of all these rocks that have been hidden and we've done nothing. We've kicked the can down the road. We've avoided any of the major decisions we've had to take. We've printed up this money with these monetary malpractice. It's got to come home to roost. And the only way we can buy more time is, as the government always does, print more money. And they'll do that. They'll change the rules. They'll change the banking regulations to allow and to extend it. But it's only buying us more time until eventually there's a real reset. And that'll be what we'll see in this stability test. That's my opinion. So until you clearly see both of those that are imminent, this is not the time to be speculating in this market. Closing comments, Charles? My opinion on what to look for.
Well, I totally agree about the trillions needed in fiscal stimulus, because the people that are being laid off and the small businesses that are closing, like $1,000 check is not going to offset their declines in revenues and wages. So they're going to have to bring it up to the level that people can pay their bills and service their own loans. My last comment is, I think a lot of sort of financial punditry type people are, some at least, are proposing a V-shaped recovery. Like they're anticipating that once the case load drops back or levels off, that we're going to get a V-shaped recovery in the economy. I am skeptical of that, and I personally am looking at a process that will probably last into September and October at a minimum. So just to reiterate the idea that investing in this kind of disrupted environment that where all these dynamics are going to be playing out for months and months and months, we should all be hesitant to make big bets.
Charles, one of the things I've learned, and I lived through the 86 crisis, and then 2000 as an investor, and 2008. I've seen this many times, and maybe not quite as bad as this. This is truly historic. But one of the things I do know is that bottoms are events, and they're often V-shaped or W-shaped. But bottoms are often nothing more than counter rallies in a falling market. So you really don't know. But bottoms are typically V-shaped in events, but tops are a process. And by a process, it means they're longer and they're dragged out. And yes, we had a high earlier this year before, and then we've plummeted down. And that may have been the final top. But even if it was, we typically have these counter rallies and move before we put in a second top. Sometimes they're double tops, but they're often M-shaped, or they're rounded, or they're domed. They're protracted. So even with policies that change and we get a trend and it starts to move up, we could have put, and I happen to think we're nearing a long-term top, and it's really centered on sound money and fiat currency. Doesn't mean that we might not have a newer higher high sometime. Some of these policies will start to look effective, but I think on a longer-term basis, when we're looking back on any long-term chart, we're due for a major period of substandard returns on asset values, and a period, as I said, of stagflation. So that's to be expected. That's why it becomes quite confusing. But if you change the value of money, which we've been doing, you can make anything appear to be more valuable. If you make money almost worthless, the Dow will be 40,000 or 50,000, right? And that's the big problem right now, is a complete, total, global, coordinated globalization, a globalized debasement of fiat currencies. And don't doubt for one moment that the government and powers to be, in desperation, won't go to that. So that's why it's particularly tough to bet on whether it's going up or down until you see these policies. But once you see the policies unfold, you'll know. Charles, let's wrap. How would our listeners find out, follow any of your reading or your articles?
Yeah, please visit me at of2minds.com and read samples of my latest books and browse my archives.
Charles,
Thank you very much.
Charles, we really want our feedback from our listeners on good, bad, hopefully constructive. Please put them up on our on the YouTube channel in the comment section, because that's why we do this. We look for your feedback and value it for various reasons, whether it's for Charles' writing or for my personal investing. So thank you very much. Charles, talk to you later.
Okay, thank you.